All right, what we're going to talk about really this afternoon is a macroeconomic look at where we are as a country and as a world, and then what it really means for you financially. A lot of this isn't really tied to trading. Some of it will be, and some of it will be tangentially related to trading. But what it's really about is what's going to be coming and what is really inevitable. And the bottom line on all this is what we've done in this country is we've created a political problem to which there is no political solution, which means that ultimately we will have to hit the wall. What you're seeing happen in Europe right now must happen here and will happen here, and it will have consequences. So I will warn you this up front. There's not going to be a whole lot of good news, okay? But I'll try to make it as cheery as I can. Starting off with just kind of a macro overview, the first point I would make is what you're seeing happen right now is very different than anything we've seen happen certainly in our lifetimes. There is a major change in the world economy. In 2008, the world was brought to the brink of ruin because two mid-sized investment banks went under. What's going to happen when Spain, Italy, and ultimately France get into trouble? One of the things that's interesting is everybody's been focused on Greece, and now there's starting to be some focus on Spain. It's become clear really for a year or more that Spain and Italy were ultimately going to become the real problems. Greece is small enough, we probably survived that, but because the French banks hold so much Spanish and Italian debt, and you start looking at things like the fact that the French banks are currently holding debt to GDP of about 250%. That is the equivalent if the U.S. banks were sitting on about $40 trillion of bad debt. Ultimately, these banks are going to fail. And let me also preface this with this statement. Everything that's happening in the world today is really designed to try to keep the banks from failing. The banks are all interrelated. They're all counterparties to each other's trades. They are all partners in each other's investments. And if you think about it from this perspective, in the world banking system, there are about $5 to $7 trillion in assets. Those banks have made somewhere between $100 and $120 trillion in loans to people who cannot possibly pay them back. Ultimately, they will fail. As the old saying goes, if you owe the bank $50,000 and you can't pay it, you have a problem. If you owe the bank $50 million and you can't pay it, the bank has a problem. Ultimately, unfortunately, the bank has a problem. Understand that going forward, it's not that, oh, everything's going to fall apart and just go down. Volatility is going to be the watchword. There will be times the markets will go up, times the markets go down. Again, I will explain as we go through here why that will be. There'll be periods of inflation and deflation. I will argue they will occur simultaneously. I'll explain what that means. The dollar will lose significant value. It already has. It will get worse. The idea that right now the dollar is doing well because the euro is going down more, it's a fantasy. We'll talk about that. There is opportunity, and this is, I guess, the ray of sunshine. If you think back to the 1930s, great fortunes were created because there was tremendous social upheaval. Whenever there is tremendous change, there is opportunity. The problem is the vast majority of people are going to get hit by a truck that they're never going to see coming. People are going to either ignore this, they're not going to hear about this, they're going to hope it doesn't happen. The problem is if these things happen, and I believe that there is no alternative but for these things to happen, and we can talk about this and we can argue about it, but the reality is if these things do come to pass, it will be life-changing for most people, and for most people that will not be a good thing. People fundamentally have to make a choice. They can be victors, they can be victims, because you can't sit this out. As I said earlier, for many years what I would counsel people is either understand how the markets work, or stay out of the markets. Both are fair decisions. To be in the market and not understand how they work is a dopey decision. You're going to lose all of your money. The problem that you have now is that you can't sit out. Because of the macroeconomic factors we're going to discuss, it will affect everyone no matter what they do. Why? First of all, it's going to affect things like jobs. We are doing nothing in this country right now that's really going to improve the job situation. You want to fix the job situation? You got to reduce the cost of labor. How do you do that? Get rid of the corporate income tax. Corporations don't pay taxes anyway. The large corporations, especially GE last year made $5 billion in the United States, and they got money back from the government. Okay? It's a rigged game. The small and mid-sized businesses are the ones that get hurt, the ones that can create jobs. If you want to reduce the cost of employing someone, take the taxes out. That tax only brings in, last year it brought in $179 billion. With all the money we waste on other stuff, I mean, that's just a few green energy projects. The reality is that's the kind of thing that would make a difference. If you essentially did not allow the government to pick winners and losers, if you got rid of the minimum wage, you would create jobs. People, well, you hate poor people. No. Understand that the minimum wage was created basically to hold a group of people down. It was not created to help people. What you are effectively doing is you're pricing young people out of a market. People who don't, look, if you can set the minimum wage at $10 an hour, if someone can't provide $10 an hour worth of value, they're not going to get the job. If someone is 16 years old, they're in high school, or they're 18 years old, they've just gotten out of high school, they don't have a whole lot of skills. If I have to pay that person $10 an hour, or I have to pay somebody who's 30 years old with some work experience $10 an hour, who am I going to hire? How does that other person ever get their first job? How do they ever move up the ladder? But that is all political poison. You can't make these kinds of arguments and have anybody vote for you, because all that will be said is that you hate poor people. The problem is that we've made it so valuable to hold office in this country that nobody will say things that are unpopular, even though those things may be true. And that is going to become a theme that we go through here today. Social Security and Medicare are bankrupt. They're not going bankrupt. They are bankrupt. There isn't any money. If people believe that they're going to get the benefits they get today 10 years from now, I think they're delusional. I think 5 years from now is a stretch, but again, we will talk about that. We divide here really the small bucket and big bucket. This is the money people use to actively trade. The big bucket is the money that people are using really for wealth creation. This is the IRAs, the 401ks, the accounts, the money that people really forget about. All of these are going to be affected by what happens, as will real estate. What we have seen in real estate is not over. And probably the best analogy I can draw here today is this. I have heard rumors, I could be wrong about this, but I have heard rumors that in the Phoenix market, there are people who lost money in real estate over the last few years. Has anybody heard these stories? Maybe it's anecdotal. Okay. No, people got crushed. Why did they get crushed? Because they thought that real estate would always go up. You can buy stuff, it goes up, you sell it, you make money. It was a bubble. We had a stock market bubble. We had an internet bubble. We have dollar bubbles now. We have treasury bubbles. We're going to talk about this. But the key to a bubble is they always operate under the greater fool theory. The argument is it doesn't matter what you pay for something. As long as there's at least one person dumber than you who will pay more, it makes a lot of sense. This is what people did with real estate. And the problems they had with real estate are the problems they're going to have with all of their finances going forward. What defines a bubble? What we see here is we look at inflation-adjusted prices, we look at actual prices, nominal prices. What's fundamentally happened is prices went up in this country about 90%, housing prices up about 90%. During the same time, incomes only went up 2%. That is not sustainable. This is the anomaly. There are people saying, well, we just have to wait for housing prices to come back up. Now, because we may face some very serious inflation, you may see housing prices go up. But in terms of actual real dollar terms, they're not going to go back up to where they were. Any more than tulip bulbs. I mean, you know, the stories are the tulip bulbs in the 1600s in Holland were selling for the equivalent of $200,000 today. That was a bubble because people were willing to pay more. They always thought tulip bulbs would go up. People literally were paying 10 years of income to buy tulip bulbs. Tulip bulbs never went back to $200,000, okay? Housing, again, in dollar terms, in real terms, are not going to go back to where they were. People bought houses up here, just like they buy stock with absolutely no protection whatsoever. You can insure real estate, and the way that you do it are with puts on the Case-Shiller Housing Index. You can buy puts on the U.S. housing market. That way, when market prices go down, the value of your puts go up, and these have been around since 2005. People could have protected every dollar that they had in real estate, and the vast majority of people had no idea this existed. And this is the analogy I want to draw. People are playing a game that they don't understand. What is going to happen to them financially? They know something's wrong, but they don't fully understand it. There are solutions. There were solutions to protecting yourself in housing, but people didn't take advantage of them. And as I mentioned earlier, everybody has fire insurance. Almost nobody has insurance. Let me ask you, how many people knew that these existed? Okay. I have, in probably 5 years of talking about this, I've had one person who actually did this. And that person made a lot of money doing this. The reality is there are tools out there, but you've got to know what you're doing. And unfortunately, the average person at this point just doesn't understand what's coming. And that's what I want to try to explain here today. The idea is, don't just try to get by. There's going to be a tremendous amount of opportunity to create wealth. Make sure that you don't just survive, but you thrive during these times. What are the skills I think people are going to need? I think people are going to have to understand options for two reasons. One is to be able to protect things they own, whether it's their houses, whether it's their portfolios, gold, oil, whatever it may be. You can buy options on everything. The other thing is that you generally cannot go short in an individual retirement account. You can buy puts in an IRA. That allows you to make money when markets decline. You will always make more money faster when markets go down than when markets go up. It is a critical skill if you want to build wealth over time. Again, for your trading bucket as well as your wealth bucket, this protection, I got to tell you, if you wanted to stop the banking crisis that was tied to real estate, why banks made you have homeowners insurance and not have puts as well on the housing market, I don't understand. Or even if they had bought them. They could have hedged all of those portfolios, but they did not. The big picture, most of what I'm going to cover here this afternoon is really where are we going, how do you know where you are, when do you want to own assets and when do you want to be short, and what is it that you should own in short. There are going to be times you're going to want to be on both sides of this. This will not be a unidirectional market. Intermarket analysis. If you want to know where the market's going on any given day, look at the dollar. If you look at the dollar overnight and the dollar's up, the market is normally down. If you look at the market and the dollar is down, the market is usually up the next day. It was certainly true going into today. High liquidity leverage trading. We talked a little bit about this earlier. Make your money work harder for you, whether it's futures, forex, or options. In this world, you either work for your money or your money works for you. The whole idea here is to make it work harder. All right. One of the problems many of us have is we came to age as investors when the market did this. You can buy and hold in that market. You can buy on the dips. You can dollar cost average. Drunk monkeys throwing darts made money in that market. The E-Trade baby was making money in that market. The reality is over the last 10 years, this has been the market. Most people look at their account statements, and quite frankly, even their account statements don't show they're even because they get in and out at the wrong times. This market, actually, you can make more money than in this market because you have these downswings where you can make a lot of money very quickly. But if you don't understand how to use puts and go short, you're missing opportunity. When it comes down to actual value of the money, though, most people have lost significant value. And we'll talk about that in a little bit. People bought, just like they bought real estate, here and did nothing to protect themselves. Again, we mentioned this a little bit earlier today. There are people who come here driving $25,000 cars with $250 deductibles and all the insurance in the world. They have $1 million stock portfolios and they have no insurance whatsoever. I don't understand how that makes sense at all. If you're going to own assets, you have to pay for the insurance and the protection, or you're just taking entirely too much risk. And that becomes really gambling. That is not investing. So here's a specific example. A couple of months ago, I sat down and I started thinking about what was coming from tax policy. And here's what we know. Stock prices are determined by supply and demand. That's all this is. If more people are willing to pay a higher price, prices go up. People who are willing to take less, prices go down. The after-tax rate of return is key when someone's making an investment decision because you spend after-tax dollars. Higher income traders really determine the marginal prices of stocks because they own more stocks than do other people. Now, if we take a look at tax changes that are coming written into law, right now the capital gains tax in this country is 15%. If you're at the top of the income heap, you have a capital gain in a stock, you sell it, you pay 15%. On January 1st, that is going to go to 23.8%. That is current law, all right? That is an almost 60% increase. We hear a lot about the Buffett rule. Oh, the rich just got to pay their fair share, right? Everybody should be paying 30%. Understand, that is going to be a doubling of the capital gains rate. What that means is that people will pay less money for stocks. Yes, it will affect the rich, but it will affect everyone because it will by necessity drive the price of stocks down. The dividend tax is worse. Right now, people pay 15%. The top people after the first of the year will pay 43.4%. People will not be able to pay the same price today they pay for stocks once these tax changes go into effect. So what does all this mean? We take the following assumptions. Let's say, and I did this analysis on April 20th of 2012, let's assume that you bought 2,000 shares of McDonald's 5 years earlier on the 20th of, and it's kind of ironic being on 420, eating McDonald's. At any rate, for my hip listeners, 420, you paid $48.36. That same stock 5 years later was selling for $95.94. So you doubled your money in 5 years. Pretty cool stuff. The dividend currently is 70 cents a quarter, which is $2.80 per year. If we take a look at what now happens to the value of this stock when we have these tax changes, again, which are coming on January 1st of next year, or if we have the Buffett rule, what happens to the value of McDonald's stock? All right, if we sell the stock on the 31st of December of this year, we have a $95,000 gain, if McDonald's price stays the same between now and then. And same thing's true if you hold it another day or if we get the Buffett rule. However, you'll pay significantly more in tax if you hold it till January 1st. Holding it one more day is going to cost you about $8,000. Now let me ask this question. How many smart people are going to hold the stock one more day versus selling it here? With the qualifier smart people, the answer becomes 0. Okay, that's not going to happen. You have the Buffett rule because we want to be fair. All right, everybody should be paying 30% tax, right? Okay, now all of a sudden it's going to cost me another 14 grand. And my after-tax gain obviously goes down the same amount. I'm in the whole 8 grand or 14 grand. What this means per share, if I wanted to have the same rate of return over 5 years, the value of McDonald's stock would have had to come down originally by about $4.18. If I have the Buffett rule, it's about $7.14. What this really tells us is the impact on McDonald's stock. On the tax on capital gains, McDonald's stock will have to go down the equivalent of about 9%. If we look at it with the Buffett rule, it has to come down about 15%. That's the good news. The dividend tax is significantly worse. And if the stock price stays the same, basically the stock, instead of being at 96, would be at about 88 or 82. All right. During this time, you get $5,600 a year on your 2,000 shares in dividends. The tax on that currently is $840. After the first of the year, if you're in the top marginal bracket, that kicks it to $2,430. That means after tax, instead of getting to keep about $4,700, you're getting to keep about $3,200. It costs you about $1,600, which means instead of getting a 2.5% rate of return on your money, you're getting about a 1.7% return on your money. The question is, if I would have been happy with a 1.7% return, I would have been willing to pay more for McDonald's stock, or I would have put my money somewhere else. Because I am not, if I want to be able to get 2.5% on my money, I will not pay $96 a share for McDonald's stock. I will not pay, in fact, more than about $64 per share. What you find out is mathematically, for all of this stuff to remain equivalent, when we have the tax increase on January 1st, the price of stocks probably have to drop at least somewhere between 20 and 30%. And that is something I think that is likely if we do not change tax policy. I also believe it is unlikely we will change tax policy before then. We'll talk about that. Do I think this is going to happen? Yeah, I think it's almost absolute. There won't be a deal before the election. It's almost certain. Why? If you think about it from this perspective, these are taxes that affect the rich. Now, the reality is they affect all stock prices because, again, stock prices are effectively marginally set by the rich because the rich buy a lot more stocks. Before the election, what are the chances, and this is not a political statement, I believe both political parties have failed us. I believe they will continue to fail us. But what do you think the chances are that Barack Obama is going to sign legislation that's going to extend tax cuts for the rich? Okay? I think it's not going to happen. And even if he was willing to go along with it, the Senate's not going to go along with it. It's not going to happen. After the inauguration, what incentive, if Obama wins, what incentive does he have to cut those taxes on the rich? Really none. He's already won, right? If Romney wins, he's already come out and said, I don't think we should cut a deal before inauguration because why cut a deal with Obama when you cut a deal with me? We're going to end up with better tax policy. So what this means is before inauguration, it's very unlikely that we're going to have a change in tax policy. So again, he's not going to cut for the rich. It's going to affect everyone. even if the Republicans get something passed, they can't override his veto. He would veto it. After inauguration, again, I don't think Obama cuts it. And here's the thing with Romney. He has said that I don't think that there should be any capital gains or dividend taxes on people making less than $200,000 a year. The question is what does he think that rate should be for people over $200,000 a year? The narrative on Romney in the media is going to be he's rich and he only cares about rich people. If the first thing he does when he gets into office is cut taxes for the rich, he's going to get massacred. That theme is going to be out there on him. And I think he's going to be very leery of that. Now, the Senate may step up if the Republicans keep control or take control. They may pass it, he may then sign it, but the Republicans are unlikely to have 60 votes and push that thing through. What does all this mean? What it means is I think that certainly before the inauguration, you're not going to have the tax rates change. You're going to have the increases that are planned. After inauguration, I think actually you may keep these taxes for a while. So does that mean the market's going to crash on January 1st? No, because smart people are going to go, I'm not going to sell on January 1st, I'm going to sell on December 31st. And when people realize that everybody's going to sell on December 31st, you go, well, I'm not going to wait till everybody else sells, I'm going to sell on December 30th. And well, I'm going to sell on December 29th. And what happens is once people price this into the market, it all comes out. Right now, the discussion you hear is there's a fiscal cliff coming. It's not just this, it's also the sequestration. We'll talk about that in a little bit. But people are talking about with what's going to happen with tax policy and what's going to happen with spending cuts, which I'm not going to argue right now, but it's all smoke and mirrors. But people are saying that this is going to take 3 to 4% out of gross domestic product next year. Now, given that gross domestic product is growing at about 2% a year, that's brutal. We're back into recession. Right now, what people are saying is this would be so horrible, there's no chance that it's going to happen. The reality is it's going to happen. And when people figure that out, that's when stock prices will start going down. I think you might start seeing some slow bleed in July and August. We've obviously got some bleeding going on right now. I think by September or October, this is ugly. Because the other thing that happens during this time frame is the debt ceiling debate will start up again. We are going to hit the debt ceiling again this year. The Federal Reserve said that they can play some games and they can keep it going through the election. But after that, that conversation is going to take place. If you remember last year when we had the debt ceiling debate, we had our credit rating downgraded, stock prices fell, everybody was in a tizzy. You're going to have that on top of this. I think it's ugly. If things are really horrible after the first of the year, you might have a retroactive cut. Maybe in March or April, stock market's swooning, nothing else is working. Maybe they go back and do the tax cuts for the rich. If so, I think you're going to see a huge market run-up. And this is why I go back to, I don't think this is all just doom and gloom. The reality is you're going to make more money here if this is correct and you're short than you will even in the run-up. But there's going to be opportunities in both directions. And the key is to pay attention again to what the institutions and the smart money are doing. All right. Why do I say this is fundamentally different? There's a lot of different reasons. The first is if you look at really our markets, both real estate and stock, and you compare them to Japan, we're essentially exactly where they are. We're just 10 years behind them. Yes, there are some demographic differences and the rest of it, but it's not material. If we look at what happened in Japan, the Japanese market went from less than 10,000 up to about 40,000, and then it collapsed. People talk about the lost decade in Japan. Japan has been in the tank, back less than 10,000 now for 20 years. That is a very long decade. Housing prices in Japan are still below where they were at the peak. In Japan, they have now done 7 rounds of quantitative easing. It hasn't worked. It will not work here either. If we look at our market, we had the same parabolic move up. We came down, we came bigger. In fact, if we overlay them, what we find is that basically we had the same slopes up, down. We did a bigger stimulus and we did it faster, but when the stimulus ended, we still came down. When we did quantitative easing too, we went up. We'll talk about the results of that later on. But you cannot print money and create wealth. Money is simply a mechanism of exchange. If we want to compare the bubbles, in Japan, their housing prices went up by about half. Ours went up by about 90%, each over about 6 years. Their market tripled. Ours essentially doubled. Japan is currently sitting on debt to GDP of about 200%. They actually have more government debt to GDP than any other developed nation. There is zero chance they can pay this money back. Can they print money? Can they keep it going for a while? Yes. But because of this and because of demographics, they are in very real trouble. This 100% number dramatically underestimates how much money we really owe, and we will get into that. So how did we get these bubbles? Well, we had a significant reduction in interest rates. If you remember back in 1980-81, we kicked interest rates up because we were going to beat inflation. Interest rates went to over 15%. For the last year and a half, actually 2 years, money's been free in the United States. It has not solved the problem. In Japan, money has essentially been free for the last 15 years. It hasn't solved the problem. The problem that you have is no one's creditworthy. Okay? People have lost so much value and they've lost so much collateral that there's no way they can borrow even if they want to. Also understand that when you cut interest rates, the money doesn't have to stay in your country. One of the reasons that we had the housing bubble that we had in the United States is you could go borrow money in Japan and you could use it to invest in the U.S. real estate market. People that borrow money in this country now can go invest it in China, Brazil, Russia, wherever they want. The money doesn't have to stay here no matter how cheap you make it. Excessive borrowing. The slide I'm going to show now I have been using since 2006. It is one of the most important ideas that we're going to discuss. Stay with me, here's what we got. The blue bar is, this is what the government tells you gross domestic product growth is. The red bar is, here's what gross domestic product growth is if it wasn't for mortgage equity withdrawals. That is if people didn't use their houses as ATMs. Back in the 90s, wasn't that big a deal. We would have actually been in a 2-year recession in 2001 and 2002 if it wasn't for the mortgage equity withdrawals. Then we were reporting in this country that things were great. We're growing 3-4% a year. Everything is wonderful, except that it was all being driven by the mortgage equity withdrawals. We were really organically growing at less than 1% a year. And what I tried to tell people back in 2006 is that one day that has to stop. One day you're not going to be able to borrow against your house. One day, it's not that you're going to have gross domestic product go back to 1 or 2%. The problem is you've got to pay all the money back. And when you pay all the money back, you're actually going to be in recession for years to come. The reason the government is borrowing and spending as much money as it can is it's trying to make up the slack. What it's trying to do is keep us from going into the recession that is inevitable. If the government didn't spend all this money now, would things be worse? Yes. But you're going to have exactly the same problem. The government cannot create value. All it's going to do is it's going to kick up the cost down the road because ultimately they're going to have to pay all that money back as well. And we're going to get into that a little bit later, but it's not pretty. Let me ask, is any of this making any sense? Yeah. You guys doing okay? All right. We've had a series of bubbles that have burst. The internet bubble, housing bubble, commodities bubble. In my opinion, we currently have bubbles in U.S. treasuries and in the dollar. I would be very, very careful of treasuries. We're running out of options to keep these things inflated. Okay, you can't really make money any cheaper than it is. Banks can borrow overnight from the Fed for 0.1%. They've been able to do so now for a couple of years effectively. That's not the problem. By keeping the rates low, though, we do create other problems. And we actually, if we wanted to be successful at this, we should actually increase interest rates, but that's never going to happen again politically. Right now what's happening is people are getting paid less on their money than what it's costing to live. So right here I have that we have a 2% yield on the 10-year Treasury. As of today, I think it's somewhere between 1.5% and 1.6%. Reported inflation is 3%. It is actually considerably higher than that. I will talk about that later. But here's the deal. If you're earning 2% on your money and the things that you're buying are costing you 3% more, are you getting ahead? This is simple math. No, you are not. This is killing conservative people. People that are trying to do the right thing, save money for retirement or they're in retirement. These are the people getting really hurt right now. What happens then to these people when 10-year rates go up? Okay, if we go from roughly 2% to 4% interest rates, bonds will lose about 16% of their value, which is equivalent really of losing about 8 years of interest on a 10-year bond. That is not a good thing. At 6%, they lose about 30% of their value. Losing 15 years of interest on a 10-year Treasury is even worse. At 10%, they'll lose about half of their value. Do you think it is possible that we could see 6 or 10% interest rates? Let me ask you this. Would you be willing to loan money to a company at 1.5% for 10 years, whose debt to cash flow was 7.5 to 1.
No.
Would you do that?
No.
I would not. Okay. That's what we're doing. And if we look at history over the last 30 years, the average that we've paid for 10-year money is 6.7%. We are at all-time lows. At some point, this is going to have to go up, and it's going to have tremendous ramifications. This is going to affect us. It'll affect other countries. It'll also affect individuals. I'm going to come back to that idea. We can't take the interest rates lower, and we can't borrow our way out of this because nobody's got any debt capacity. The balance sheet recession idea is very important. One of the reasons that this is fundamentally different than most of the recessions we've had in this country is that it's not just that we overexpand and whatnot. We leveraged the hilt out of our houses. And we used that money to go buy TVs, to buy second houses, to buy cars, to take vacations. All that stuff is fine. But we weren't using that money to go out and build factories. We bought a lot of stuff. When we couldn't borrow against our houses anymore, we couldn't buy a bunch of stuff. So business really suffered. Global trade went down almost 10%. These guys, the banks, loan money to the businesses to make stuff, and they loan money to us to buy stuff. The idea was we would be able to borrow and spend forever, and they would be able to grow forever. When those two pieces of the equation fell apart, these guys got hammered. This is why we have a banking crisis. You've got $5 to $7 trillion in assets supporting something around $100 to $120 trillion in loans. There is no way the math works. Everything we're doing around the world right now is designed to prop up the banking system because the fear is if one large bank goes under, they all go under. And there may be truth to that. In fact, at some point there is truth to that. Ultimately, though, you cannot create enough money to save them. One day they will go under. Now, let's take a look at the components of it. On the consumer side, all right, stay with me on this. What this says, if you look at the blue line, is the United States. There's, by the way, a housing bubble in Canada right now. We can talk about that if you want. If you go back and say, in 1990, what was the average amount of equity somebody had in their house? And we index that to 100. What you see is as housing prices went up, a whole bunch of equity. Well, now two things have happened. We've borrowed a lot of money against those houses, plus housing prices have come down. The average person today has the same amount of equity in their houses that they had in 1978. They have lost a tremendous amount of value. A few months ago, I read somewhere that the average person currently has less than 6 months' income in equity in their house. And that is the first time since the 1950s that's been true. Historically, the house has always been the safe store of value. If you lost a job, you needed to send a kid to college, you wanted to retire, whatever it was, you could go to the house for money. There is no more money in the house. And the reality also is there's nobody to sell the house to. If we look at non-housing assets, basically stock portfolios, what you find is we're back where we were about 10 years ago. People are feeling poor because they are poor. Their incomes aren't going up, their net worth is in fact going down. Business is in the same boat. What this shows us is in the red is government borrowing, the blue is effectively business borrowing. When business borrows money, one of two things happens. It either uses the money productively or it goes bankrupt. And both of those things can happen. But what's happening because of the change in the economy is that business is actively deleveraging. Business is trying to actually refinance or repay debt. Government is stepping in to make up the difference. Is that helping support the economy? Yes. But ultimately, it cannot create value. Government, all it can do is take money from you and give it to me or vice versa. It cannot create anything new. Whoa, but what about all these green energy companies? Well, what about them? There's plenty of venture capital out there. If they were good investments, the private sector would do it. What is happening right now is it's theft. They're taking money from other people, giving it to their favorite political cronies, and it's not creating value, and these companies are going under left and right. The problem with not taking the hit now and not taking the hit a few years ago when we should have taken it is one day all this money has to get paid back. And that is going to cost us for years, if not decades to come. The government. If you look at Japan's situation, if you just look at how much they pay for the money they've already borrowed and their equivalent of Social Security, that is all the tax revenue they collect. Every other dollar that gets spent in Japan is borrowed. We are actually getting very close to that. If we look at the United States, Based on various measures using reasonable assumptions, the federal government's current fiscal policy is unsustainable. Continuing on this imprudent and unsustainable path will gradually erode, if not suddenly damage, our economy, our standard of living, ultimately our domestic tranquility and national security. When I first read this, I focused on the domestic tranquility and national security side. What this person's really saying is, if we keep spending money like this, we might see riots in the street, we may not be able to defend ourselves. You may think we should have been in Iraq and Afghanistan, and you may think we had no business over there. Reasonable people can disagree. You may think we should be doing something about Iran and in Syria, you may think we should have nothing to do with that. Again, reasonable people can disagree. But here's the problem. If you think you should be doing something in those places, but you can't because you're broke, that's the problem. And that's what this person is pointing out. I have been using this quote since I first read it in January of 2007. David Walker was effectively the head accountant for the United States. He's a nonpartisan guy. Clinton put him into office. He stayed working under Bush. This is part of the executive summary to the annual report, official government document. And what he said 5 years ago is, if we keep doing what we're doing, this is not going to be good times. Shortly thereafter, he left. You can see him on TV a lot. He goes around basically telling the world this is not going well. Now let me ask you, are things better now on this front than they were 5 years ago? Are we doing a better job on the budget? I would argue not. Okay. Here's the deal. At the end of 2006, and these are phony numbers, we'll get into this, but basically we told the world we had about $8 trillion in debt. We are now at over 15 trillion, almost 16, and in fact we have crossed this 100% line. The debt clock. This is as of a couple weeks ago, and I just want to show you a few things. I know this is hard to see. What we officially acknowledge as money we've borrowed is just about $16 trillion. The gross domestic product, everything we essentially spend in this country, is about $15 trillion. So when you look and you want to have that apples and apples of debt to GDP, we have now crossed that 100% barrier. There's some research out there that says once you cross about 85, 90%, it costs you about 1% of gross domestic product growth. A couple of other things to note here. The first thing is that right now we're paying about $225 billion a year just in interest on the debt. This is because we can borrow money at less than 2%. We start having to pay, if we owe $16 trillion and your interest rates go up 1%, that costs you another $160 billion a year. You go to 6% interest rates, all of a sudden I'm having to come up with about $800 billion a year just to pay the interest. Where's that $600 billion going to come from? You're not going to be able to raise it in taxes. No one's going to have the guts to cut it out of spending. All it's going to be is more debt and more borrowing. We are headed toward a big doom loop. And this is one of the reasons they don't want to raise interest rates. You and I also owe about $16 trillion. This is individual debt. $13 trillion of it is what we owe on our houses, about 30% of which right now are underwater. That's not a good thing. All this, in fact, is a bad thing. Oh, one other point here. We spend about $3.6 trillion a year. We bring in about $2.2 trillion a year. So this number is growing by about 8, 9, 10% a year. Last year with the budget deal on the debt ceiling increase, they said if we do this, even with the cuts that there were in those plans, we were going to be at $24 trillion in debt within 10 years. Keep that in mind for a moment. All right. All bad, not the problem. Here's the problem. We have promised people about $16 trillion in Social Security benefits that we don't have the money for. This is not the cost of the program, it's what we can't afford. $20 trillion in prescription drugs and $82 trillion in Medicare. Medicare is the black hole. Could you fix Social Security by raising retirement ages, means testing? Yeah, you can do that. You can't fix Medicare. And the reality is that the overhaul that would be required to keep Medicare going, you'd never get through politically. You know, last year, Paul Ryan, whether you like his plan or not, came up with a plan, and the first thing was we were going to push grandma over a cliff in a wheelchair. Okay, I mean, you know, and that's what's going to happen. The demagoguery will be unbelievable. So if we put this into stuff we can understand, if this is your household budget, you make $50,000 a year. You spend $82,000 a year, and you have promised people you're going to pay them about $4 million. Okay, what are the chances you're good for this $4 million? I will argue very small. Okay, and the reality is we're increasing the spending every year. Even when we're cutting, all we're doing is cutting the rate of growth. We pretended last year that we cut our spending by the equivalent of $640 this year. We actually are spending more. We didn't cut anything. But even if we were going to give ourselves the benefit of the doubt, now we're only going to spend $81,360. We're still only making $50, and we're still committed to the $4 million. This is why I say, do you want to bet that Medicare and Social Security are going to be there for you? There's not a chance. If you're trying to draw the current benefits 10 years from now, I think there's no chance of that happening. We use the way forward machine. We get in with Sherman and Peabody, and we go to this day in 2016. This assumes we don't make any major changes, which I believe is the most likely case because no one's got any guts to do anything. In 4 years, we're at 22 trillion. Now remember, if we did everything right in 10 years, we were at 24. We're just not even dealing with reality here. So now we're at 22, gross domestic product, and I think this is aggressive, is at about 17. Interest on the debt is 451, and that assumes no increase in interest payments. We have increase, in interest rates. You have increase in interest rates, this number is going to be close to $1 trillion. We're only bringing in $2 trillion. So half of all the money we bring in is going to go just to paying interest on the debt. How are we going to come up with another $800 or $750 billion? Social Security, because we're all older now, is $20 trillion in the hole. Prescription drugs are $27 trillion in the hole. Medicare alone is over $100 trillion in the hole. There is no possible way that those things can be fixed. According to this, what it tells us, our unfunded liabilities are about $146 trillion. It's worse than that, and we'll get into that in a little bit. If we now look at the projections, and one thing that's really interesting, if you remember when we had those surpluses back in 2000 and the Clinton surpluses, the only reason there were surpluses is because we stole money from Social Security. We never lowered spending. We never did, okay? But this is what the government is telling us our little ramp is like. This, I will argue, is unattractive, okay? We're talking about, and this is a U.S. government document, this is coming from the Treasury, and what they're telling us is, and you can say, well, we won't be around here. And here's the problem. By 2027, you're bankrupt, okay? You're bankrupt. There's just nothing that you can do. The reality is you're bankrupt now. But this is what our government believes is some sort of reasonable plan where we're going to be sitting at debt to GDP of 300%. Who is going to give us money? We're laughing at Greece because they're at 130, 140%. Okay? There's no way that this is sustainable. And in the famed words of Herb Stein, if something can't go on, it won't. Something that you'll notice, kind of this same pattern, is how long people stay in office. And this is a fundamental part of the problem. What you see is the Senate is in the little gold here, the House in the black. What you're seeing is people are staying longer and longer. Even after 2010, where you had this watershed election and we threw the bums out and the rest of it, 85% of congressional districts did not change party. Because the reality is the system is so broken, the gerrymandering, the rest of it, you don't have any choices. People say to you, well, vote for the other guy. It doesn't matter who the other guy is. The parties are only interested in staying in power. And as long as that is their sole goal, they're going to do what's going to keep them in power. And telling you the truth is not going to keep them in power. Because the harsh reality is no one is going to vote for the guy who tells the truth. When someone says, oh, by the way, you think you're getting Medicare, that's not going to happen. You want a home mortgage deduction, that's not going to happen. You want 99 weeks of unemployment, that's not going to happen. You want an export-import bank, a Department of Education, EPA, none of that stuff's going to happen. At some point, those things will all stop. We can either stop them voluntarily or they're going to be stopped by the outside. It is the classic golden rule. He who has the gold makes the rules. One day we're going to have to go hat in hand to China or whoever it is and say, we really need a few $1 trillion here. Can you help a brother out? And they're going to say, yeah, but here are the rules. From now on, Medicare kicks in at 75. Social Security kicks in at 75. It only goes to these people. You're getting rid of all this stuff. They are going to determine how we save money instead of us making rational decisions today. And that is, unfortunately, I think, the future we face. Now, why do all these people want to be in office? So this is something that's kind of fascinating to me. And if you do a little bit of analysis, I think this is kind of interesting. Between 2004 and 2009, if you look at the average American family and you take all the stuff that they own and you subtract all the stuff that they owe, they really were no further ahead or behind than they were 5 years earlier. Compare that to the real 1%, the members of Congress. 24% of members of Congress during that time had their net worths double. Almost more than 1 in 3 of them had their net worth go up by at least 50%. Understand the people that had it double started at $850,000 in net worth. 5 years later, they were worth $3.6 million. They had an increase of about $2.7, $2.8 million over the 5 years, and they make $174,000 a year. Now, we know what geniuses these people are with money, right? I mean, they're just better at this than you and I. But how does this happen? And let me also explain this. I've never seen this really explained this way, but you can go to opensecrets.org. They have all this is based on is the financial disclosure forms that come from the members of Congress themselves. All right? So this is just the stuff they tell you about. Charlie Rangel, he's got the place down in the Dominican Republic that he forgot about, collected money on all those. Yeah, none of that stuff counts, okay? The stuff they give to their kids and they're hiding, none of that stuff counts. This is what they fess up to. And what I did when I did this is I didn't just say in aggregate. I looked person by person, okay? So these were actual increases that these people had. As of 2011, basically half these people were millionaires. The average net worth of a member of Congress is about $2.6 million. Now think about this for a moment. If you run for office, your life's a living hell, okay? I mean, it's hard work. You're out there all the time. You're begging for money. People are calling your mama ugly. Everything you ever did wrong or they thought you did wrong, that's coming up. If you've already got an average of $2.6 million, why do you go through that so that you can make $174,000 a year? And it's my opinion that there are two kinds of people who run for office. The first is the people who really want to do the right thing. They are the true believers, and they think, quite frankly, they're smarter than everybody else. Once you're there for a couple years, you should actually figure out if you're smarter than everybody else, that you're not going to be able to get anything done. But the second group of people is they realize that there's an awful lot of money in this. The reality is they're both exactly the same person. They are effectively narcissistic personalities. These are people who believe the world revolves around them. And those, unfortunately, are the people that we have in government. And the reality is this job's worth a whole lot more than $174,000 a year. So how do these guys do it? First thing, these guys get the best stock market returns out there. There was a study done in 2004, I'll probably butcher his name, but Professor Ziobrowski. He looked at 6,000 trades that were done by members of the U.S. Senate. What he found was this. The average person underperforms the market every year because they have no idea what they're doing. Corporate insiders trading only their own company's stock beat the market by 5% a year. Members of the U.S. Senate beat the market by 12% a year. Not only do they beat the market, the year before they buy a stock and the year after they sell a stock, the stock underperforms. So they have absolutely perfect timing. This paper won Paper of the Year in the Journal of Quantitative Analytics, the rest of it, I mean, this was a serious academic work. In 2009, he testified in front of Congress. He said, I don't know if this is a good idea or a bad idea, I don't know if it should be legal or illegal, but there is zero chance that this is random chance. You guys are trading on non-public information. And at that point, he also had done the calculation to find out that the House of Representatives beats the market by about 5% a year because they don't have as much power as the individual senator because there's more of them. There was something called the Stock Act that was in front of the House of Representatives. 9 members of Congress signed on to co-sponsor this. And basically, it was to stop this kind of stuff. 9 people cared. The bill died. Last year, a guy named Peter Schweitzer wrote a book called Throw Them All Out. He talked about that particular study, some other studies, and then he had some more contemporary examples. He had examples of Nancy Pelosi, John Boehner, and then the biggest one in his book was a guy named Spencer Baucus. Spencer Baucus, and again, I'll use the word alleged here, it's being investigated, whatever, but Spencer Baucus is a Republican from Alabama. He was in a meeting in September of 2008 with the head of the Treasury, the head of the Federal Reserve. Select members of Congress came to that meeting. It was so secret you couldn't even bring your cell phone to the meeting. They were told how bad things really were. According to Schweitzer, again, allegedly, what did he do? He went out and he bought a bunch of put contracts on the S&P 500, betting that the market was going to go down. That turned into hundreds of thousands of dollars in profit. Okay? Again, this is currently being investigated, but you'll be happy to know, yes, he won his primary battle. He's going to be back there next fall. Okay? This is how bad this is. So, Schweitzer comes out with this book he gets on 60 Minutes. Everyone's outraged. Oh, I'm outraged. All right? They passed the Stock Act, but the Stock Act is totally watered down. The reality is this is not going to affect anything because part of the problem with trying to create a rule to stop these types of things is once the rule was written, Now I can find ways around the rule. And until there's another crisis, you're not going to go and rewrite the rules. So the guy who goes second always has an advantage. Plus, there's so much money in it, you can hire lawyers and you can make this work. Plus, Congress is the people who fund the SEC, who are the people that have to look into Congress. So if you're at the SEC and you hack off the wrong person and you get your budget cut, that's not a good thing for you. The bottom line is none of this is really going to change. But let's say they lost all of this. What do they got left? Well, they got the land deals going on out there. Dennis Hastert was a high school wrestling coach. He goes into Congress. He leaves Congress. He's worth more than $10 million. How does this happen? Well, one of the ways it happened is he did himself a pretty good land deal. He bought some land a few miles away. Believe it or not, the government put a road through. He sold his land, made millions of dollars in profit. Heath Schuler's got land deals. Nancy Pelosi's got land deals. Harry Reid's got land deals. Rick Perry did a land deal with Michael Dell. All these, and none of this stuff's illegal. But it's a way of funneling campaign cash to people. You go back to Hillary Clinton's cattle futures days, all right? This is their story, and they're sticking to it. Hillary Clinton did one cattle futures trade in her life, okay? She made $100,000 and then never did it again. Does that all make sense to people? Is that what you would do if you made $100,000 in your first trade? Okay, a guy named Larry Williams, who's a very famous commodities trader, went back and he looked at those trades. He said, zero chance that that is what actually happened. But what you find out is the person that was her broker was tied into Tyson Foods. Tyson Foods was and again, I'll use allegedly for all this, but it's pretty much out there. Okay, Tyson Foods was the largest employer at the time in the state of Arkansas, and her husband was governor. Again, you can draw whatever dots you want. Maybe it's random chance, maybe it's coincidence, maybe she's the greatest trader that ever lived. All those things could be possible, but I would be somewhat suspicious. They have relatives who are lobbyists. They manipulate campaign funds. Let me kind of run you through a few of these. I'll do this kind of quick. There's a group called CREW. It's Committee for Responsibility and Ethics in Washington, I think is what it stands for. So they did a study, and what they find out that 82 members of Congress are paying their relatives basically with campaign funds. 44% of them have family members who lobby or employed in governmental affairs, which means they're lobbyists. 90 members have paid a family business employer or associated nonprofit. So what's happening is you raise all this campaign cash, and it really is a big slush fund, and you can use it for anything you want. 20 members use their campaign money to contribute to a family member's political campaign, not like this is a little class. 14 members charge interest on personal loans. This is a classic. There's a woman, Grace Napolitano. 1998, she loaned her campaign $150,000. She charged her campaign 18% interest. So every year she makes 18% on the money, comes out of the campaign. It's a pretty sweet deal. Cora McCaskill leased her plane to the campaign for $300,000. I mean, it's all there. This is a gold mine. 38 members earmarked. This is the one that blew me away. 38 members earmarked money from your tax money to a business that either their relative worked in or controlled. One of the guys alone gave money to two businesses that his two sons owned. Okay. That's criminal. And this is the thing. All of these things are legal. And when I did the radio show several weeks ago, a couple months ago now, I said something at the very end of the show I'd never thought before, but it struck me as really, really important and to some extent profound. As long as they live as kings, we will live as subjects. We have created a class of people who are not subject to the same laws we are. Congress doesn't participate in Social Security. They're not part of Obamacare. They're not subject to the Americans with Disabilities Act, minimum wage, OSHA, any of that stuff. They are above all of that. We can't allow that to happen. But we have created a political class that gets so much benefit from having that power and being part of the political class, they'll never give it up, which means they will never take hard stands, which means I don't care who you vote for. Will things be somewhat different if it's Romney versus Obama? Sure. But will any of them cut spending? No. Because you're never going to have 60 senators, 218 members of the House, and a president who all step up and say, hey, let me get rid of some of my power. That's never going to happen, and that is why you must hit a wall. They get insider stock, they get board positions, and so much more. And again, the bottom line is these people are never going to give that up. Recovery, stimulus, grow our way out, and all the other painless remedies are just claptrap. Nor is the U.S. government going to double all taxes. Congress doesn't have the stomach for it, and it wouldn't help anyway. The economy collapsed even further, leaving possibly less revenue for the feds. Now, there's only one real solution. The feds will have to renege on their promises. But how? Well, they step up to a microphone and just admit they have been fools and knaves. They're cutting federal spending in half. Will they look the voters in the eye and tell the truth? I can't give you anything that I haven't taken from you in the first place. Whatever your party, which is a very important idea. Whatever your party affiliation, we wouldn't advise you to hold your breath waiting for politicians to be straight with voters. No, they use the only tools they have. Lies, bombast, and subterfuge. One way or another, sooner or later, they'll call upon the Fed and the Treasury to bail them out. How? By using quantitative easing. Money printing, in other words. Treasury will borrow the money from the Fed, the bills will be paid, and the dollar will become almost worthless, or perhaps completely worthless. 2 weeks after this article appeared in Business Week, they announced QE2. Okay, it is why there's also going to be a QE3, and we'll get into that in a little bit. Now, Lawrence Kolikoff's an interesting guy. I've interviewed him a few times on the radio show. Smart guy. He's a professor of economics at Boston University. He was one of Reagan's senior economic advisors. He actually, I don't know if he still is, but he was running for president on the Americans Elect Party. And what he does every year is an analysis of all the unfunded liabilities. In 2010, his number was $202 trillion. If you take all the money that we've promised that we don't have, 202. In 2011, he updated it. We owed $211 trillion. In 1 year, we went up $9 trillion because we're all getting older. Demographically, I saw this stat a few weeks ago. 10 years ago, for every new person retiring, 10 people entered the workforce. Today, for the first time, for every one person retiring, one person enters the workforce. In 10 years, for every one person entering the workforce, 10 people will retire. That is why we're in deep trouble. It's simple demographics. All of this stuff was a Ponzi scheme. We are paying out the existing people with the new people's money. Unfortunately, you will run out of new people. Japan's in trouble, we're in trouble. Europe, we know the good times they're having over there. What this essentially shows you, and this is, I think, quite interesting, is by country, and this is Belgium over here, they have one bank that's holding debt that's equivalent to 180% of Belgian GDP. That's a really big number. Okay, those people got serious debt. France, the three top banks are holding debt equivalent to 250% of French GDP. Yes, the eye does get drawn to Switzerland. One bank alone is sitting on loans equivalent to about 4 times Swiss GDP. Now, Swiss GDP is not all that large, but that's still a pretty big nut to carry. What's interesting is actually the U.S. banks don't have nearly the loan exposure that these other countries do. But this is one of the reasons Europe is in trouble. And the other part of it is they all owe each other money. And it's not the same counterparty, so you can't just wipe the debt out and make it all clean. These people owe money that they can never possibly pay back. Europe is in very deep trouble. People are concerned, if Greece goes under, what happens? Spain, Italy are the much larger problems. Soros put it this way: if the euro were to break up and cause a banking crisis, that would be totally outside of the control of the financial authorities. It pushed not only Germany, not only Europe, but also the whole world into conditions very reminiscent of the Great Depression in the 30s, which was also caused by a banking crisis that was out of control. Whether he's right or whether he's wrong, this is the fear. This is why nobody wants these countries to go under, and no one wants these banks to go under. It's why the socialists in Greece think they have some leverage. What they're saying to their people is, vote for us. They really won't throw us out of the euro because they know they're cutting off their nose to spite their face. That may be a good gamble, that may be a bad gamble, but that's the gamble. But this is why certainly they can't let Spain go under. But because they can't really ever save these guys any more than kicking the can down the road, it's why ultimately the euro must fail. What's going on in China? All right, few things. The first thing I will say about China, it is not transparent. There are a lot of rumors about what's happening in China, bad loans, bad banks, we don't know. The second thing I will say is politicians always make political decisions. If you allow a politician to allocate money, he will do it in the way that's best for him. He will give the money to people who will give him bribes and kickbacks. He will give it to the military that will keep him in power. He will give it to family members, friends. It's not going to go to the highest and best economic use. In China, that's how they distribute money. More and more, it is how we distribute money over here. Ultimately, that is going to come back to haunt them. It has to. Their stock market last year was down 22%. Going into this year, over the last 3 years, it was down by about a third. And in fact, at that point, it was the worst performing major market in the world. And markets lead economies. If the smart money thought that China was going great, you wouldn't see the market taking the hit it's taken. They're very dependent on Europe, which is a problem. They depend on commodity prices, which are currently in dollars that I'm going to talk more about in a bit. And now the government's trying to slow things down, but they're going to try to do it under control. Last quarter, growth came in at 8.1%. That sounds like a lot. But a few years ago, they were growing at 10 or 11% a year. The estimate is if they fall below about 8% growth, you're not going to be able to absorb all the new workers coming into the workforce, and you're going to have problems. But the big problem immediately is real estate. They've tripled their money supply since 2004, which has fueled a real estate bubble like we've done here by having a lot of cheap money. Real estate is currently about 13% of the Chinese economy. It's about 6%, it was about 6% here at its peak. If you add in construction and all the things tangentially related, that's about a quarter of the Chinese economy. This is a big chunk of what's going on over there. Now, there was a tremendous amount of housing speculation in China. Prices were up through the roof. Governments, as governments do, because they're so thoughtful and nuanced in their steps, they said, we're going to stop this. We got to get rid of this housing bubble. So last fall, they did a couple of things. First, people used to buy a lot of houses that flip houses. What they said is, bless you, you're not going to do that anymore. You get one house. Nobody can own more than one house, unless you're connected to the rest of it, but you get one house basically. Second thing is, down payments are now 50%. You basically blew up the housing market in one fell swoop. So what did we have? Well, going into this, if you wanted to buy a flat in Shanghai, 1,000 square foot flat was about $335,000. That was what the average person in Shanghai made in 45 years. In Beijing, it was about 36 times income. At the peak in the US, it was about 4.5 times. This is leverage. Now what you're saying to people is you've got to come up with 22 years of salary to have a down payment on a house. What do you think has happened to the housing market in China? Has it gone down slowly? No, it has not. Okay, when this was announced, in 1 month, condo sales fell 40%. They're now sitting on 22 months of inventory. And in the major cities in the month of October, housing prices in a month fell between 25 and 40%. The government is revisiting this. Perhaps they were hasty and made to get this under control. But China has some very real issues. And part of it is this command and control economy. This morning when I was driving in, I heard someone talking about how what China was doing was so brilliant when they're building these cities for 1 million people where there's 20,000 people living there because they're thinking about the future. You can't plan better than a market can plan. If there's demand, there will be supply. If there is not, there will not be. So what are we going to do? Well, all we got left is the quantitative easing. What happens is they don't really print money. The Fed creates dollars. They just do some journal entries and they say, well, we used to have $10, now we got $1,000, right? We can buy debt from the bank. We can either buy bad debt or we can buy government debt. And now the banks have money that they can loan out to everybody else. But consumers got no collateral. Most people don't have any way of accessing this capital. And people say, well, the banks aren't lending. The banks aren't lending. Okay? But it's because no one's creditworthy. Business is actually actively trying to deleverage. So where's the money going? It's going to the federal government, which is keeping the whole thing going, and it goes into whatever the next bubble is. All right, how does this apply kind of on the investing side? When they announce another round of quantitative easing, and there's a rumor that they may even announce one tomorrow, I'd be a little surprised, but maybe it'll happen. From when that happens to when it ends, you don't want to be short, okay? Because here's what happens. The United States, our announcement, Japan, their announcement, from when that started to when the quantitative easing ended, in both cases the market went up 16, 17%. However, once it's over, the markets go down. In fact, if we take a look inside quantitative easing 2 in the United States, and again, Japan's done 7 rounds of this, and their stock market's still down 75%. Housing is still down 60%. It doesn't work. Why are we doing it? Because we told the Japanese that's what they should do. We don't know any better. We announced it here. We started it here. Stock prices in QE2 went up also 17%. And I gave a talk on this in March of 2011. And one of the things I said was, as you get towards the end of this, stock prices are going to come down. They may come down in advance, kind of like what I talked about with the tax situation. It may be the day after. It may be a couple months after. You don't want to be short here, but you got to be real careful being long in this area. Now, here's what was fascinating. In the weeks coming into the end, the market was coming down. And all of a sudden, there was a huge influx of cash into the market. Trying to research this, nobody knows where the money came from. Was it the Fed? Was it the Treasury, the plunge protection team? Was it big banks? Was it other governments? We don't know. But the idea was to try to keep it going. They tried to push it a little bit higher. The whole thing collapsed. We put $600 billion into the economy, and within 45 days, the stock market was in worse shape than it was before we started. But that $600 billion went to somebody. And it went to all the people who went short and all the people who sold up here. And as we said earlier, that can be you, it can be Goldman Sachs, that becomes your choice. Why are we going to do another round? Now also understand, since March of 2011, I said there would be another round. At that time, everyone said there won't be another round. By last fall, everybody said there will be another round. As of a couple months ago, there wasn't going to be another round. There has to be another round. And like I said, they're talking about it even maybe being announced tomorrow. Here's why. We've got to refinance almost $6 trillion of debt over the next 5 years. Plus, we're running $1.3 trillion, $1.4 trillion a year in deficits. We got to come up with $10 to $12 trillion over the next 5 years. Where's that coming from? The problem Europe has isn't the new borrowing, it's the refinancing all the stuff that's coming due, because you got to roll that debt over. Who has $12 trillion to give to us? Whole world economy is only what, 54, 60 trillion, somewhere in that range? Is the world really going to give us 20% of all their money just to cover our debt going forward? I don't think so. When we did QE2, the Fed was buying over 80% of all the treasuries that were issued. Japan's broke, they can't do anything. China was net selling, they're now net buying, but they're not buying anything like that kind of volume. And in fact, if we look at what's happened, private came in when everybody was scared back in 2008, 2009, nobody knew where to put their money. They bought a lot of our debt, a lot of our treasuries. They've fallen off the face of the earth. Foreign buyers are going down. The people buying the debt right now is us. We are buying our own debt. And in many cases, paying Goldman Sachs for the privilege, which is quite nice. It's a good business to be in. The reality is there's no one that has the money to buy the debt. We will have to continue to print money. We will have to keep the monopoly money going, but ultimately it will stop. What's going to happen when we do it? It'll be pretty much like last time. Stock, commodity, and bond prices are likely to go up from when it's announced to when it's completed. The dollar is going to continue to lose value. If we look at what's happened over the last 10 years, the dollar's lost about 40% of its value. People have lost real purchasing power. Again, they look at their account statements, they say, well, at least I'm pretty much even, I haven't lost anything. They've lost purchasing power. You got to learn to do things, and one of the big messages of all this is you want to do things not in US dollars. If we look at it in gold terms, if you say how many ounces of gold does it take to buy the Dow Jones Industrial Average? In 2002, it would take you 33 ounces of gold. By 2007, it would only take you 19 ounces of gold. The stocks had lost, compared to gold, about 40% of their value. Since 2007, right now, we're hovering right around 8. We've lost about 75 to 80% of the value of our stock holdings compared to gold. Whether you want to call it real money, whatever you want to do, that's purchasing power that's been lost. And again, the average person has no concept that that's going on, just like they didn't understand what was happening with real estate. When the dollar loses value, you can't sit it out. And this is why I say this is the most important skill. Putting your money in a mattress, putting it in a bank, a CD is not going to get it done. I think stocks are something you want to look at. Commodities, I think, are very important because the inflation is really going to help them. I wouldn't be in real estate. Even though inflation may drive real estate prices up, there's no liquidity. Okay? There's huge transaction costs to start with, but who am I going to sell to? By the way, you want to solve the real estate problem in this country? You've got a supply and demand problem. You got too many houses for the number of people. You can do one of two things. You can bulldoze houses, which destroys value and is stupid, or you increase demand. How do you do that? You don't have people you don't give people checks to stay in houses they can't afford. You increase immigration. Okay? What you say is if you come to this country, you buy a house at the current market price, you don't go on government assistance, and you make your payments for 5 years, I'll give you citizenship. Okay? It brings in productive people. If someone can make a house payment for 5 years, they're contributing something to society. They can't all be drug dealers. I guess maybe half of them. Okay, I mean, the reality is, I was in Australia for a while. Back then, if you had $250,000 cash monies, you could get citizenship. They wanted people coming in that had money that could invest. Same basic idea here. But could you ever get this through without being demagogued to death? Not a chance. Protect your big bucket, your IRAs and whatnot. Understand what's happening overseas, both multinationals and foreign nationals. What else? Stronger currencies. Currently, the Swiss government is artificially holding down the value of its currency. That never works. I don't know when it will break. At some point it will break, and I would look at that. This is a biggie. Reserve currency status. How are we getting away with printing all this money? Well, part of it is because it's all supply and demand, okay? There is demand for dollars that's effectively an artificial demand. In 1944, in the Bretton Woods Agreement, we went off essentially the gold standard for the world, and we went on to a dollar standard. Transactions between countries now are going to be denominated in dollars. So if you were in Germany and you want to buy oil from Saudi Arabia, you got to get yourself some dollars. So people have to hold on to a certain amount of dollars just to do international commerce. But that's been eroding. 12 years ago, we were 71% of the world's excess currencies. We are currently about 60% of the world's excess currencies. China and Russia agreed in 2010 to no longer trade in dollars. They will use their own currencies. December of last year, China and Japan agreed to do the same thing. That has not yet been implemented, but that has been agreed to. A few months ago, China agreed that they were going to loan money to South Africa, India, and to Russia in yuan, not in dollars. You will notice a common thread here. China is taking the world off the dollar standard. I don't know what their political ambitions are. I don't know anything else. But if you want to beat the tar out of the United States without firing a shot, you take the world off the dollar standard. You'll crush the currency. It'll be devastating to this country. And you can do it all without firing a shot. And if I was going to hazard a guess as to a scenario, we're going to need $12 trillion. Even China doesn't have the $12 trillion. But we go to them and say, hey, help a brother out. Come on, give us $3-4 trillion. Say, all right, we can do that. Here's the price. We're going to become the world's reserve currency. And we'll transition over a period of 5 years, but that's what's going to happen. The president needs the money. He'll take the deal. Plus, there'll be a transition, so they won't blame him for it when it all goes south. But we will not be able to say no to that deal. And that is the problem with running the debt that we will have. We won't be able to say no. We can't say no to that. We can't say no to the austerity. Okay? Which leads me to ultimately conclude that I'm not sure we don't break up like the Soviet Union. I'm not sure that we survive all of this. And that is a scary thought, but yet another reason I would not be dependent on dollars. This is going to affect everybody in this country. In fact, it'll affect everybody in the world. But whether they think they need to be in the stock market or understand this stuff or not, they're going to get whacked by this. So now you also have an inflation problem. I've seen this graph a few places, but I'll show you something I've never seen before. What this is the balance sheet of the Federal Reserve. Going into the crisis of 2008, the Federal Reserve on its books had about $800 billion. QE1, QE2, the stimulus, all that stuff kicked us up to about $2.8 trillion. This is unprecedented, the amount of money that's come in. If we do a QE3, this could go to $3.5 trillion, you could go to $4 trillion. You could do a 5, you could do a 6 before the world catches on. Now here's what's brilliant about this. That looks bad. But I remember the speech that Greenspan gave back in 1999. And it was when we had the Y2K problem coming up. If you remember Y2K, the world was going to end. Computers were going to stop working, planes would fall out of the sky, there'd be no more physics, it was all going to be bad, right? Alan Greenspan gave a speech in which he said, the Federal Reserve is going to step in and throw some money into the economy to make sure that stuff didn't grind to a halt. And in fact, they were going to risk inflation by doing that. This is the money they put in for Y2K. It was about $50 billion, okay? 2001, 2 planes crash into the Twin Towers. It takes $1 trillion out of the economy. The Fed steps in with the money right here, about $30 billion. We are in a world we have never seen before. And again, this will have consequences. So coming to a basic discussion of inflation. You got more dollars chasing goods. Last year what the government told us is that prices went up 3%. The target's 2%, so we're 50% above, but everybody's okay with that. But it's all BS anyway. What they do is they say that 41% of your household budget, you spend it on housing, okay? And housing went up 1.9% last year. And you say, really? I thought housing was going down. Well, because they don't do housing like that. What they assume is everybody in the United States rents their house, okay? And then rents went up 1.9% last year. It's a totally fictitious made-up number. It has nothing to do with what the average person actually is spending on housing. Housing is actually down over the last 5 years. I'm going to come back to this idea. Here's the other piece of it. They say, well, the average person spends about $6 out of every 100 on recreation, which means everybody else is having more fun than I am. But that only went up 1% last year. So 47% of the CPI was growing at 2% or less, which means that everything else went up at 4.1% last year when you do the math. Gas was up 9.9%, food was up 4.5%, apparel was up 4.6%. Here's the problem. You have deflation in the single largest asset that almost everybody owns. They're losing value here. Everything they have to go out and buy is costing them significantly more. The government's saying inflation isn't an issue, but when people are going to the store, they see that it's an issue. And this is where people are feeling a lot of pain. What they have in assets is going down in value, and what they have to buy is going up in price. This is really hurting people that are making 1.5% to 1.6% on their fixed investments, or 1% in a CD, whatever it may be. If you did the calculation the way you used to do it in 1980, last year inflation was over 10%. But we have changed the equation, one, to make it look like inflation is low so the Fed can keep interest rates low, and two, to keep down the Social Security cost of living adjustments. It makes things cheaper for the government. If China slows down, or if we ever start doing any better, inflation, right now one of the things saving us is there's just so much excess capacity. During this time, again, you don't want to be in cash. I don't like real estate for reasons we've talked about. I think fixed rate bonds are a sucker's bet. And I even think tips are a sucker's bet at this point, given how they calculate it. I think people can make a lot of money. They know what they're doing. Most people will not. Looking at it from this perspective, if we look on an annual basis, the orange line is inflation if you go places and eat things. The blue is if you don't go anywhere and you don't eat anything. And what they'll tell us is since 2000, basically inflation is less than 5% a year. How even at that, there's a cumulative effect. Prices are up if you go places and eat things by almost 35% over the last 12 years. How many people's stock portfolios are up 35%? How many housing prices are up 35%? How many people are earning 35% more? The reality is that most people have lost significant purchasing power. They hear inflation is 2 or 3%. It can't be a problem. Over the cumulative time, it's a huge problem. Lenin, and I won't get it exactly right, but this is close, he said inflation is the greatest way of confiscating wealth that a government has. It is a tax. It is a tax that is incredibly efficient, and as he put it, not one man in a million can ever see it. But this is a way that they're essentially confiscating wealth from you and I. So if you want to cut inflation down, what do? We're at this point going to have to pull a couple of trillion out, and by the time this is done, it might be $3, $4, or $5 trillion out of the economy, and that's going to take years. You have to increase interest rates, and you have to increase reserve requirements. This is going to keep our rates down of growth for years and decades to come. As the country starts growing, you have all this excess capital in there, you're going to have to find a way to suck it out. Now, you may go off a dollar standard, and you may actually start using another currency over here. I hate getting into the tinfoil hat, black helicopters crowd, but at some point that could happen. This, again, is the cost of not taking the hit today. We are only making the problem worse going forward. Deficits have to go up. Every 1% right now costs us an increase in interest rates. Every 1% costs us $150 billion a year. By 4 years from now, this number is going to be over $200 billion a year. You go back to 6% interest, once again, more than half of all your revenue is going just to pay interest on the debt. This will cause losses. China and Japan will both probably lose at least $300 billion on this, but nothing compared to what we're going to face. All right. At the end, it all goes back the other way, and you want to look at being short. Last couple of ideas, and I'll let you guys go. From 2002 to 2008, the market was up 50%. It gave it all back in a year. This is why I said it's really important to understand how to use puts, how to go short. You will always make money faster to the short side than you will to the long side. Doesn't matter what you trade. Same thing is true of oil. 11 months up, 3.5 months to go back, because fear is a more powerful driver of human behavior than is greed. So what are the choices that the average person faces? The dollar is losing. It's going to continue to lose value. Sitting in cash is not going to be an option. Interest rates have to go up. Bonds, CDs, other fixed income instruments are not the answer. In fact, those people are going to get devastated. Don't know when that's going to happen, but it must happen. Real estate, I don't like the transaction costs. I don't like the liquidity. Especially, as we age as a society, who's going to be buying all those McMansions out there? Social Security, Medicare, prescription drugs, they're already functionally bankrupt. There's no way that 10 years from now they can be the way they are. I'm not even sure you can do 5 years from now. I think everyone has to actively learn to manage their assets. Or you can learn to say, do you want fries with that? Okay. If you remember back in the late 90s when everybody would quit their jobs to become day traders, and they made money because the market was going up, and it was easy. Everybody, this was the greatest thing in the world. Then the market went down, they got wiped out, they had no idea what to do, and they had to go back and try to find a job. Once you get to be my age, you're in your 50s or older, and you're trying to find a job, especially with what we're doing in this economy, which is not going to be any of the right stuff, we're not going to significantly cut taxes or regulation. Okay, we can go to a 25% corporate rate. That's not going to matter in the long run. Okay, you got to get rid of it. You got to get rid of the regulation. There's a lot of stuff you can do. The best advice I can give the vast majority of people out there is, if you're not going to learn to do this, no matter what you do, hang on to your job. Okay, because it's going to be way easier to hang on to that job than it is going to be to go out and find a new one. What else does it mean? There's going to be periods of inflation, deflation, the dollar losing value, not just down, but volatility. But when you're long, buy the insurance. Like Tom was talking about earlier, you know, I had the $50 stock and watched it go to zero because he didn't believe the guy that told him he should buy some puts on it. Beware of what's happening this fall, and you're going to have to get rid of the old bull market bias. Buy and hope, dollar cost averaging, buying on the dips does not work in a volatile market. It only works in an up market. Up markets are rare and will become rarer. You're going to have to be long and short, again, selling short and puts, especially in individual retirement accounts. Last thoughts. Don't, and if I can get one message across, if you lost money on your house, don't let that happen to your portfolio. You could have protected that money in the house, but most people didn't understand how. Understand, learn how to use options to protect your portfolios. You can use it to protect IRAs and 401ks as well. Your trading bucket as well as your wealth bucket. Use leverage. Make your money work as hard for you as possible, but as we talked about earlier as well, probability, risk, then leverage. Options, futures, Forex will all do it. To me, the reason I'm an options trader is I can get protection as well as leverage. You're not going to be able to sit it out. The world isn't going to let you. What you own will lose value in real terms if you try to sit it out. And I really believe this is a generational opportunity for people. Just like in the 1930s, there were vast numbers there was vast amounts of wealth created because it was a change in the social order. That is coming as well. And people can take advantage of it, or people can become victims. And unfortunately, the vast majority of people can end up on the wrong side of it. And I will also say this, something I've said to business owners for years when I've kind of laid these scenarios out. And when you talk to business owners, they understand that there are very real problems. Can't always articulate them. But one of the things I would say to them is, I could be wrong about all this, okay? But if you do these things, and I'm wrong, you still come out of it okay. If I'm right about even the majority of this, and you try to ignore it, and you think it's not going to happen to you, you're totally hosed, okay? And this just becomes kind of the classic type 1 and type 2 error. What are you going to bet on? And the way I would say it to them is, are you willing to bet everything you own that I'm wrong? Because I've spent years going through this. I don't know how it all ends. Again, I don't know if you break up. I don't know if people secede. I don't know if there's insurrection in the streets. I mean, you think about this. The day we tell all these people they're not going to get their Medicare, their Social Security, all the rest of this stuff, we have 300 and some million people in this country. 1% is over 3 million people. 3 million people can raise a lot of hell. Okay, what are we all just going to sit and go, oh, it's okay, don't worry about it, it's all going to be good? Okay, I don't think so. What you've seen in like Ohio and Wisconsin, all right, where people getting up in arms because we promised them things. Listen, I come from, I've spent my time in unions in the day. We had a deal, okay? You told me you were going to do this for me as long as I did this. I did this. Now all of a sudden you're changing my deal. Would I be hacked off? Yeah, I'd be hacked off. Now the reality is we don't have the money to fulfill the deal because the government was promising money that it didn't have. Ohio, Wisconsin, various states have to do what they do. But what are we going to do the day we have to bail out California? Okay? One day the government is going to have to bail out California, Illinois, Nevada, I don't know which one first. And what's going to happen, my guess is, whoever the personalities are at the time, you're going to get your Rush Limbaugh, Sean Hannity, Fox News, whoever it is, they're going to find some woman in California who's a retired school teacher, on disability, working for a union, pulling in about $300,000 a year in taxpayer money. She is going to be the welfare queen in a Cadillac of our day and everything that's wrong with the system. New York Times, NPR, MSNBC, whoever's on the other side, they're going to find some school teacher in Illinois, 40 years old, who has 23 children with Down syndrome. Okay? If she doesn't get her pension, these kids are all going to starve. And there are going to be these battling anecdotes. And a bunch of people in the middle of the country are going to go, what on earth are we doing bailing out these people in California? But we will bail them out because we will have no choice, because no politician is going to give up all of those votes. That party would be toast. That, I unfortunately think, is what's coming. And actually started to see this a little bit. The woman collecting unemployment and welfare after she won the lottery and doing that for a year, people got a little bit upset by that. There were some people in Seattle that were collecting all kinds of government benefits, living in this multi-million-dollar condo on Lake Washington. There is a lot of abuse in the system, and there is going to be a lot of anger. And the other part of this is, if you go back to the road to serfdom, one of the points that Hayek makes is that the smaller the community, the larger your government can be, because there's a commonality of interests. You have a family, you have a small community, everybody's pretty homogenous, it's all fine. The bigger you get, the smaller government must be, because the larger government is going to always be giving favors to one side versus the other side. One group of people is always going to be resentful. If you look at what's happening in this country, when Bush and the Republicans were in control, half the country was hacked off. When Obama and the Democrats were in control, the other half of the country was hacked off. Because government, when it has that much power, you have to suck up to government. You have to ask them for favors. And it pits one group against another group. I have lived in San Francisco, and I've lived in the middle of nowhere in Colorado. Those two places have nothing in common. Are we even really one country anymore? These, unfortunately, I think, are the conversations that I think we're going to have going forward. And I'm not sure what all of those answers are going to be, but this is not going to go smoothly. And you get into then, what do you do at the end of the day? And you can kind of take two roads. You can try to go out and lead the revolution, and if you're there, I wish you the best. Or you do as Voltaire said, and you go out and you cultivate your own garden. You find a way that you can get through this yourself, your family, whatever. You do the best you can. But quite frankly, trying to take on this system right now, I don't know how you do it. I think you're tilting at windmills. I just don't know where the answer is. Because what we've just talked about here, there's a lot of people in politics who understand these issues, and there's nobody talking about it. Because again, that will only cost them their power.